thank you all for taking some time today to learn more about tax strategies to increase cash flow. We're excited to present some of those strategies, and hopefully we can give you some ideas to save some cash. Got a great group of presenters today. So we've got Mark Rogers. He heads up our fixed asset services group here at Eide Bailey. We'll also be hearing from Joe Swatsky. He heads up our energy incentives practice. And I am Joe Stoddard. Welcome. All right, there are obviously lots of tax strategies to increase cash flow, way more than we can cover in a 1-hour webinar, but we've selected some of the key strategies a lot of our clients are able to currently utilize in terms of getting the biggest bang for their buck to cover today. So we'll be talking about the employee retention credit, newly enhanced. So we'll walk through some of those new rules. We'll talk about R&D tax credits. We'll talk about fixed asset services, and then finish up with energy incentives. So let's just, without further delay, let's dive into the employee retention credit. So this employee retention credit was first passed as part of the CARES Act back in March. So it's been around since March 2020, recently enhanced, and we'll talk through those enhancements. But before we do, we need to kind of set the foundation for these rules. So first off, the ERC, I'll use the term ERC, is a refundable credit. For those non-tax folks on the webinar today, that just means it will offset the employer portion of payroll taxes. This is a payroll credit, but any credit above and beyond that amount is refunded. So you don't have to carry it forward or use it towards future tax liability. It's fully, you can monetize it immediately. For the 2020 credit, the original rules allowed for a 50% credit on up to $10,000 of qualified wages per employee. So that meant a maximum amount of credit of $5,000 per employee. So that could still add up pretty quickly. Eligible employer, what is an eligible employer for the ERC? There's really two ways to qualify. One is more of a black and white test, and that is, did you experience a significant reduction in gross receipts? If the answer is that to yes, then you're an eligible employer. The way that's defined in the original CARES Act is you have to show a 50% decline in gross receipts in any 2020 calendar quarter compared to the same quarter in 19. So it has to be a pretty significant decline. Or the other way to qualify as an eligible employer is to show that you've had either a full or partial suspension of operations due to a government order related to COVID-19. Now that government order can be related to restricting travel or group meetings or other types of operations related to your business. A really easy example to understand here is maybe we have a quick serve restaurant that has a drive-through. If a government order forced the restaurant to close their dining room, but they remained open for drive-through service or takeout service, then they would be considered partially suspended. Even if they had an increase in their sales in 2020, they would still be eligible because they would be partially suspended operations. There is an important distinction between a small employer versus a large employer. And that threshold for 2020 in the original CARES Act was 100 full-time employees. So if you had 100 full-time employees or less, and you're an eligible employer, you can take this credit on all wages paid during the eligibility period. If you're a larger employer, so more than 100 employees, you can only claim the credit for wages paid where employees are not providing services for at least part of the time. So you think back to it, especially early on during COVID, when there was some forced, at least short shutdowns of a business for a certain period. If employees continue to get paid, they would have, and not performing services the whole time, they would be eligible for the credit during that period. The original rules had this credit expiring at the end of 2020, and you could not take a PPP loan and also claim the ERC. most of our clients took a PPP loan, so that ERC wasn't very high on their radar. Well, that story changed. So at the end of 2021, as part of the Consolidated Appropriations Act, Congress made a retroactive change that allowed you to go back and claim an ERC for 2020, even if you took a PPP loan. So that's a huge change. So I would say any company that took a PPP loan should at least evaluate whether they can go back and qualify for this ERC for 2020. One important note, you cannot claim the same wages you used for PPP forgiveness for the ERC. So we'd have to, if you use the majority of your Q2 wages, for example, on your PPP forgiveness application, you'd have to exclude those wages. But any other wages you paid in 2020, as long as you were eligible during those other periods, would be allowable for the ERC. In addition to that retroactive change, Congress also significantly enhanced the ERC. These are prospective changes. So now you can also claim the credit for Q1 and Q2 of 21. The credit rate went up from 50% to 70%. And instead of having a $10,000 aggregate maximum of wages for the whole year, you're now allowed to claim up to $10,000 of wages per quarter. So if it's up to a $7,000 of credit per employee per quarter. Congress also raised the threshold, the small employer threshold, significantly from 100 to 500. So any company that's less than 500, as long as you're eligible, you can get the credit for wages paid to all employees, not just those that were not providing services. The other thing that Congress did at the end of 21 as part of the year-end COVID legislation was to increase the qualification for different types of entities, specifically for governmental entities. This is primarily geared at public colleges and universities or hospitals that were precluded in 2020 from claiming the credit. That opens up in 21. The other nice change they made for 2021 is it's easier to qualify using the gross receipts test that I mentioned earlier. Earlier, you had to, and for 2020, you had to show a 50% reduction in gross receipts to qualify. In 21, you only need to show a 20% reduction in gross receipts compared to the same calendar quarter in 2019. You're also allowed additional flexibility to look back at the prior quarter. So for Q1 of 2021, for example, you can either show that you had a 20% reduction in gross receipts in Q1 compared to Q1 of 19 to qualify, or you can look back at Q4 of 2020, and if your Q4 of 2020 was more than 20% less than your Q4 of 2019, you would also be eligible for Q1 of 21. So a little bit complex, but you're allowed to use different quarters to qualify. You still have the option of using the partial suspension of operations test as well. So if you don't meet the gross receipts test, that's another option to still qualify for the credit. As you're looking at planning for this in 21, if you think you're going to be eligible, you'd also need to want to consider whether you're planning to claim or to take out a second round PPP loan if you're eligible for that, and just do a little bit of planning around which wages you're using for which provision. If you can maximize your PPP loan forgiveness in 21 and also claim the ERC, there's some planning you can do around that. We are still waiting for IRS guidance on the interplay. We know that you can't use the same wages for forgiveness and for ERC, but there's lots of open questions around that. One that comes to mind of particular note would be, especially for looking back to 2020, a lot of companies use way more wages on their PPP forgiveness application than maybe they needed to, just because it didn't matter. They're out of simplicity, we're just putting wages on there. So maybe you took out a loan for $100,000, maybe you put $150,000 of wages on your forgiveness application. You would think you would be able to use that difference, that $50,000 for the ERC, but we're waiting for additional guidance from the IRS on exactly how that will work. There is a quick example on here just to kind of, I guess, point out the level of benefit you can get here. Simple example, 100 employees, if you're an eligible employer for both quarters, again, you can take the credit for all wages paid. You could potentially max out at $1.4 million of ERC for Q1, Q2. So a relatively large benefit for relatively small companies if you're eligible. So certainly something to keep on your radar and dive into if you think you might qualify. All right, so we've covered our first strategy for increasing cash flow, the ERC. Now we're going to switch gears with the ERC bringing a brand new incentive. We're going to go to an oldie but goodie, the R&D tax credit. This one has been around since 1981, but continues to be a key incentive to help with cash flow for companies that qualify. So we'll dive into some of the basics around the R&D credit. So the R&D credit is it's an incremental credit. So if you're claiming the credit for 2020, for example, you would look at back at base years and figure out what expenses in the current year are compared to base years. The nice thing is, even if your R&D spend is relatively flat, you still get a nice credit. Typically, the credit falls within the range of 5 to 8 cents of your qualified research expenditures, or QREs. So we'll talk about what types of expenses qualify as QREs here in a minute. But if you had a couple $100,000 of wages and supplies used for R&D purposes, that could be generally somewhere in the neighborhood of about $15,000 of dollar for dollar tax credit. Most states have an R&D tax credit as well. So you can take both the federal credit and the state credit for where the R&D is conducted. And a few states have credits that exceed the federal benefit. So my home state of Utah, for example, often the benefit for Utah can be in excess of 10% of the expenses. So if we add both federal and Utah credits together, we often get north of 15 cents on the dollar of the eligible expenses. So it can be a very nice benefit. And we'll talk about this later, but you can also use the credit in certain cases to offset payroll taxes. You may hear this term, you need to do an R&D tax credit study, an R&D study. What is that? It's essentially doing an analysis to figure out what credits are available. We can look back at the prior 3 years and amend those tax returns. And we can sometimes go back even further than that, but the general rule is 3 years to claim the credit for the current year and the prior years. Unlike the ERC, this is not a refundable credit. It is an income tax credit, so you can use the credit to offset income tax. Any credits that are not used can be carried forward, and they carry forward for 20 years. So what types of activities qualify for the R&D tax credit? The first thing I like to say is people hear the term R&D, and in their mind, that's someone with a white lab coat, a test beaker, and a Bunsen burner. And certainly that type of R&D typically qualifies, but it's a much broader definition than that. Any R&D around this concept of a business component, this is a tax term, can often qualify. That can be new or improved products or processes or software. Looking at new or improved techniques, formulas, inventions, all those types of things qualify. This next slide has some examples of what we would look at. So in these kind of 3 general buckets, from a product standpoint, this could be a manufacturing company. And again, this can be an improvement to an existing product. So you may have an existing widget and you're looking to make some reliability improvements to your widget. That type of activity would typically qualify. Brand new product development, looking at other types of products, and again, product is sort of a generic term, and this also kind of ties into the manufacturing process development. But again, from a manufacturing standpoint, looking at new or improved fixtures or molds or dies, that sort of thing would typically meet the criteria as well. Anything you're doing from a manufacturing process standpoint to improve efficiencies, get better throughput, reduce waste, that sort of thing would be something we would look at for the R&D credit. Often bringing in new pieces of equipment, even if it's off-the-shelf equipment, that'll require changes to the process, and that can often lead to eligibility as well. Software development is another big area. That can be technology companies developing software for lease or license to third parties. But in today's world, many companies that are not software companies are doing development. Maybe you're developing an app to interact with your customers, or doing some other sort of software customization for software they use internally. Any money or time spent developing software can be considered for this credit as well. And then beyond that, we do work with a lot of engineering companies, for example, that are designing bridges or buildings or roads, that sort of thing, other types of things as well. So this is not an exhaustive list, but some ideas of the types of things we run into for this credit. I mentioned earlier this concept of QREs, or qualified research expenses, and there's really 3 buckets of eligible types of expenses. So we can include the wages paid to your in-house folks that are involved with R&D. That includes the direct involvement in the R&D efforts, direct support, so the person actually doing the thinking and the problem solving, anyone supporting them, maybe helping with some testing or something, and direct supervision. So supervision time also qualifies. For some of our clients that are in a closely held small and medium-sized business, often the owner or the founder of the company, he or she may be involved in either directly in the R&D or supervising it. That type of supervision time can qualify as an example. Supplies are also includable. The most common thing would be in supplies is if you're doing prototyping and testing, any supplies used in that, whether it's the component materials of the prototype or other testing materials. Often if you're doing some scale-up work and doing some trial runs and that sort of thing, those raw materials can be includable as well. And then the third bucket is contract research. So if we're going out to third parties and using them to help with R&D or to help with testing or any other part of the process, we can look at the contract research expenses or anything paid to a third party as well. I alluded to this earlier. There is a component of the R&D tax credit. This is typically an income tax credit, but there's a component that would allow you to use this for payroll taxes. This is really geared towards startup companies. So if you're a startup company, and there's a definition here of what a startup company is. Generally, if you've been around for less than 5 years and have less than $5 million in gross receipts or sales, you'd be eligible to make this election to use the credit to offset payroll taxes. So it just provides some additional flexibility if you're not in an income tax paying position to monetize the credit by using it as a payroll tax credit. Just a few case studies of some of the clients of our clients we've helped with this, and it kind of runs the gambit of the different types of companies. So this first example, we have a client that's a software company. They make software for the legal industry, a case management software platform, and then they also the platform allows for a very customized, tailored solution for each of their clients. They happen to be in a state that has a nice state credit, so they're able to. And this is not a huge company, but they're able to get up around $300,000 of tax credits each year. Another one of our clients that we help with this, they're a manufacturer and distributor of consumer products. They have a whole range of different types of products, ranging from office products to different hobby types of products and luggage. They're taking the credit on their new product design and product enhancements. They're in several states, so we're identifying federal as well as several state credits for them, and they're able to get up between $60,000 and $100,000 of combined credits each year. And our final example on here, we worked with a structural engineering firm. This was an initial study, so we did the current year. We looked back at the prior 3 years as well, looking at some of their engineering design activities, and they were able to get a combined federal credit of $111,000. So just a few examples of the different types of industries that can apply here. Okay, with R&D tax credits, there's a documentation requirement, and there's no specific requirement here. It's the general rule that the IRS has that says you need to be able to have sufficient documentation to support any deductions or credits that you're claiming. So obviously the term sufficient documentation is a little bit fuzzy and subjective. Most of our clients, when we start talking to them about R&D, they say, well, I haven't been tracking this very well. I don't know exactly how much time people are spending on R&D. And that's okay, but we do need to be able to gather and retain documentation to support the credit. That documentation substantiation can certainly be supported by employee testimony and that sort of thing. So we kind of go back and look at the types of documents you have, whether it's be informal or formal documents, and use that to help support the credits. And the way we approach this as a firm, we have a tailored approach that we can be very flexible to your situation. If you've never claimed an R&D credit and would like help with this, we'd love to help you. Before we even dive in at all, we do an initial feasibility, usually get on the phone for a half hour to an hour, talk through it, make sure it makes sense. That's a no charge type thing. If it does make sense, we would go into the phase one. Phase one is a scoping exercise to see if you're eligible, we figure out if you're eligible in the feasibility piece. Phase one is figuring the approximate amount of the credit. You know, are we looking at $10 a credit or $100,000 a credit, and really narrow that in. And then the phase two is the detailed work to finalize those numbers and get the documentation in place. This is really the reason we structure it this way is so that if you have a fairly modest amount of credit, we can do a modest analysis and make sure that the cost benefit makes sense. If you're going to go claim a great big credit, that's great, but you're going to want to have a much more detailed, robust report to substantiate that. So that helps us, by doing this phased approach, it helps us make sure that the whole cost benefit of doing the analysis makes sense. We also do what we call these refresh studies, where after you do the initial analysis, every year, if you're still eligible, you go claim a credit, and we do an update of the documentation and the calculation for that year to claim the credit. And with that, my part of this is done. So I'm going to pass it over to Mark Rogers to talk about some of our fixed asset work. Take it away, Mark.
Before you turn off your camera, Joe, one question for you, coming from another Mark in the audience. How do you file for or get the ERC if you qualify?
Great question. There's several ways to do this. So of course it's more complicated than it needs to be, but the most common way is to file on your quarterly payroll filing, your 941. So you'd either do that. So if you're going to go back for 2020, obviously those 941s have already been filed. You can go back and amend those 941s or put it on your original filing. There's also there's a way to get an advance payment of your ERC by filing a form 7200, but most of our clients are using the 941 route. I should have mentioned, Mark, one more thing. We do have an hour dedicated webcast on the ERC. There's a lot more details we can get into when we have more time. So we have that scheduled for February 10th. So if you're looking for another hour of CPE and want to dive in deeper on ERC, join us on the 10th for additional details.
Very good. Thank you. So I am Mark Rogers, leader of the Fixed Asset Services team. I'll be talking about cash flow ideas in the fixed asset space and really focusing on the latest and greatest news in the energy incentive field. Okay, so I have a team of 25 people, architects, engineers, CPAs, professional engineers, modelers, just a motley crew that are working to get deductions and credits in the built environment. And essentially, we're trying to answer these two questions for our clients. Are you in the mood for deductions? Do you own, lease, or design buildings or building improvements? And if the answers to those two questions are yes, there certainly has been a lot of provisions the last 7 years that could help taxpayers get deductions and credits. So we're calling this the lucky 7-year building streak. And I'll very briefly go through this and then an example or two from there. But starting in 2014, the IRS and Treasury released the tangible property regulations. And what that allowed you to do was, on the book side, if you were capitalizing something, and our capitalists, and then the tax side of the house too, if it went through a gauntlet of tests, betterment, restoration, adapting to new use, potentially expense it as a repair and maintenance item on the tax side of the house. So there'd be a book to tax difference, but the good thing would be that on the tax side of the house, you get that immediate expensing deduction in year one, besides having to wait for it. Fast forward 3 years, the TCGA came out and allowed for 100% bonus. So anything with a recovery period of 20 years or less gets 100% bonus. A lot of your real property is at 39 year or 27.5 year, but if you can chunk through a cost segregation as much as possible into a 5 or 7 year recovery period, that number that you segregated can get 100% bonus in year one. And another thing the TCGA did was make bonus available to acquisitions. So before the TCGA, if you acquired a building, you could still do a cost seg, still grab deductions of the 5 and 7 year variety, but you couldn't bonus out those deductions. So besides getting it in year one, you would get it within 5 years, right? Whatever property you segregated. Well, the TCGA said, now if you acquire, you can get 100% bonus potentially, just the same as if you're building new. Another 3 years passed, the CARES Act of 2020, and this was a really big one. So qualified improvement property has been around since 2016, but because of some snafus in how they wrote the tax law, we didn't get 100% bonus on QIPP until the CARES Act. So think of your renovations, your remodels, your improvements. Things to the interior potentially can be 100% bonused out in year one if they qualify. And then a short time ago, and Joe alluded to this a little bit with the ERC, was the Consolidated Appropriation Act had some more goodies above and beyond the ERC. The 179D energy deduction was made permanent, which is a beautiful thing, and the 45L energy credit was extended through 2021. So a lot of good news during this 7 years if you're renovating, building, or acquiring property. And here's what we're looking at here is a building life cycle. So deduction and credits are available at every stage of a building's life cycle. Many times with our client base, we'll hear about a building bought or a building being built, and we'll do a cost segregation. And if, let's say, the building is $1 million, we might be able to segregate 20 to 30% of that and get a $300,000 deduction in year one at the time of acquisition and or place in service date of the building. However, it's the space between building and purchasing where we're finding a lot of value and where a lot of these provisions are hitting. It's the renovations that happen 5 years later. Maybe the remodels, changing out a roof, new HVAC, redoing the break room, adding on for capacity. That's where things start to get interesting. So cost segregation is still there, but then you get the repair studies. You know, do you really have to capitalize? I know for book you might have to capitalize, but for text you really need to capitalize changing out an HVAC unit. Maybe not. QIPP is a big one. I would say of renovation and remodel costs we see from our clients, 60 to 80% of those costs are qualifying as QIPP and getting 100% bonus. And it's a relatively easy thing to do when compared to maybe a full-blown cost segregation study. So a lot more value there in the QIPP. So the ask here of our clients and of us is to look holistically at the building life cycle and the portfolio and find where we can save money and increase cash flow throughout any stage. And a good thing about all these provisions is that you could look back retroactively and grab it. It's your deduction, it's your credit. If it's sitting out there hiding, you can go back and grab it at any time. All right, so I really want to focus on QIP. That's the one that is getting, from the CARES Act, that's getting a lot of attention, and a lot of taxpayers are using it. So it's a classification of assets for interior, non-structural, can't be residential, it can be hotels, cannot be apartments, condos, and the improvement has to be improvement. It has to be placed in service after the building was placed in service. And so what happened in the CARES Act, the fix they made was they changed QIP from a 39-year asset to a 15-year asset. And by making that change, anything under 20 years or 20 years or under becomes bonus eligible. So by making that change, all of a sudden QIP is 100% bonus through 2022. And after that date, I think the bonus scales down to 80% then 60%. So still a really good answer even beyond 2022. Some common items that are not QIP, look out for enlargements, elevators, escalators, structural framework as defined by law, and of course residential. And I'll make this point too, they retroactively made this the law. So we are forced to take an opportunity and look back to anything remodeled or renovated or improved since January 1 of 2018. So it's not often that Congress and the IRS kind of force our hand to take opportunity. You never need to do a cost segregation. You never need to do a repair and maintenance study. You can depreciate these things for as long as you'd like. Except with QIP. QIP, that property is deemed a 15-year asset, and you must take it as a 15-year asset if it's clear to you that it should be that way. You can elect out a bonus for it, but you have to give it that 15-year recovery period. So how are we handling that? We have 50,000 clients. I don't know how many of them have building and building improvements, but we're filtering through right now with what we call our TADA, Tax Asset Depreciation Assistant, where we're collecting the data, we're running our macro, and we're dashboarding these ideas, well, these provisions, and finding the QIP. And while it's searching for QIP, we're also finding the optional benefits too. So right now, behind the scenes, I know we have a lot of our clients on the phone or part of this webcast right now. This is what's happening in the QIP space to make sure that we comply with the latest law. Really quickly, some industry tidbits. On the healthcare front, we are doing a lot of non-for-profit hospitals. You wouldn't think that makes sense because we're getting deductions, and why would NFPs need deductions? But a lot of times NFPs have entities that are for profit. And we achieved one recently, a $10 million deduction for a for-profit entity for a hospital out in Reno. Financial institutions, we have done over 50 banks this year, and I think it's because banks are constantly remodeling or opening up new branch locations. Banks are doing very well, and we're getting the deductions that come with those. On the manufacturing, again, a lot of renovation and manufacturing and building new. What we're seeing even more so is adding on to take up capacity, maybe a new warehouse and fitting that out for some new machinery. And then 179D plays well, and Joe Sawatsky will talk about that next. And then in dealerships, lots of dealerships, because dealerships, the manufacturers are mandating re-imaging remodels, right? Or even acquiring and building new dealerships. So a lot in that space. But keep in mind, the Lucky 7 building streak, all those provisions is really agnostic towards industry. If, again, go back to the two questions, if you're making money and you have buildings, these deductions can be applied to you, all the way from trampoline fun parks to real estate developments. It really does not matter. If you're in the mood for deductions, they're there to be had.
Thank you, everyone, for spending a little time to talk about some opportunities here in the tax space. My name is Joe Swatsky. I head up the Energy Incentives Department here at Eide Bailey, and I'm going to talk about two provisions, specifically 45L and 179D that Mark touched on briefly, and what that looks like both currently and moving forward. So before we dig into the actual provisions themselves, just a 30-second backstory, is both 45L and 179D are, for all intents and purposes, tax products, right? Tax credits and tax deductions. But it's a situation whereby it requires some professional engineering, energy modeling, HERS rating, some additional disciplines not typically associated with accounting firms. And so the partnership, to their credit, a couple of years ago, got together and said, boy, we should really be taking these things in-house and offer these services, these tax products to our clients. And so since that time, we've been growing pretty well, have a number of professional engineers, energy modelers, and the like. And kind of you see the middle there of that Venn diagram, the Eide Bailey difference. That's kind of our unfair competitive advantage that allows us to both obtain these deductions and credits, as well as work with the tax folks to implement them as seamlessly as possible. And so far, so good, and the results have been positive, to say the least. So we'll start with 179D. So 179D is a provision. It's up to $1.80 per square foot deduction for qualifying real estate. You can see there it was recently been made permanent, dissimilar to in the past where 179D was part of these extender packages where they would come online and then expire every 2 or 3 years, sometimes retroactively. Finally, we have a permanent extension here. So we're excited about that, and gives our clients and ourselves the opportunity to do some tax planning around this potential deduction. We're going to talk about two different venues or avenues on the 179D, both for privately owned buildings. On those, you are able to claim this deduction going back to any project that placed in service as of January 1st, 2006. And then we'll also touch on public projects or governmentally owned projects. I think there's kind of an interesting opportunity there for us. In that case, you're limited to open tax years, and amended returns are required. And we'll get into all that here in a second. So the qualification requirements for 179D, and we won't go through the nitty-gritty details on this, but you need to demonstrate a certain energy efficiency over an ASHRAE 90.1 baseline. And that's done through IRS and Department of Energy approved software. Needs to be certified by a professional engineer licensed in the state. And those energy efficiencies are split up into 3 categories. Each one of these categories is worth up to 60 cents a square foot for a total of $1.80. So you think about envelope, walls, windows, roof, things of that nature. You got the mechanical systems, HVAC and hot water, as well as the interior lighting systems. This chart here just kind of gives a summary of the partially qualifying property requirements, certainly more information than we need to digest during our short time here together today. But just understand that there are a number of ways to obtain this deduction depending on the energy efficiencies of your building. It's relatively cumbersome, but there certainly are opportunities there, both on projects moving forward, as well as projects, as I mentioned, going back to 2006. So let's talk specifically about that $1.80 per square foot for building owners. Now this is, as Mark mentioned, he talked about QIPP studies, so repair studies, cost segregation studies. This is a variation on that theme, right? If one is interested in maximizing deductions for any particular tax year, it's simply another lever to pull or another option that may be advantageous for you to pursue. So take a quick look at case study here. You can see a new manufacturing distribution center. This is in the Pacific Northwest. You can see the entire $116,000 or 116,000 square foot building qualified for the full $1.80 deduction, yielding a $209,000 deduction for the client. Oops. We mentioned about projects being placed in service in prior years, and this is specific to privately owned, we'll talk more about governmental in a second, slightly different rules there. But on privately owned, you're able to go back to anything placed in services as of 2006. You take the deduction in the current tax year through an automatic change of accounting form 3115 and the corresponding 481A adjustment. And it's an automatic change of accounting method. So assuming you fill out the form properly and have all of your I's and T's dotted and crossed, it's an automatic change allowed by the IRS. So on the privately owned side, here are the kind of the triggers that we like to keep an eye out for. Obviously, privately owned, looking for to increase their deductions or your deductions. Typically, these 179Ds are done in conjunction with a cost seg. Again, another lever we can pull. Because it's on a per square foot basis, typically we're finding 25,000 feet or thereabout to be kind of that threshold where the math is interesting enough and compelling enough to pursue a study. And although there are obviously outliers on that, specifically if we're looking at portfolio projects, but as a rule, that's kind of the fact pattern we're looking for on the privately owned side. All right, so let's switch gears and talk about 179D as it pertains to the designers of governmental buildings. So quick backstory on that. So the IRS and the Department of Energy got together and said, boy, we'd like to incentivize going green or energy efficiencies. And to do that, we will give folks a deduction of up to $1.80 per square foot. But governmental entities, all the way from the federal government, Air Force, Army, all the way down to the local municipality, they don't pay taxes, at least in the traditional sense. And so this $1.80 per square foot deduction is, for all intents and purposes, meaningless to them. And so to incentivize energy efficiency across governmentally owned buildings, there's a provision that allows these governmental entities to assign the deduction to the quote unquote designers, which we'll talk about in a second. And so let's kick this off with just a couple high level examples. So here you can see this is a renovation of an elementary school in the Midwest here. There's a retrofit of the mechanical system. You can see that's in yellow there. Seeing renovations on the mechanical side, that's a real good beacon for us. We have great success in terms of qualifying projects that have these mechanical systems upgraded. So there you can see the entire 190,000 square foot building qualified for the full $1.80. And in this case, it yielded a $353,000 deduction for, in this case, it was the architect. This one was a little bit easier of a project. This is a new construction of a fine arts center in the Dakotas. Entire 80,000 square foot building qualified, yielded a $144,000 deduction for the designer. Here you can see some additional examples of potentially qualifying properties. We obviously won't go through each one of these lists, but with some exceptions, the vast majority of all governmentally owned projects could qualify for this 179D deduction. Everywhere from student housing to correctional facilities to museums to libraries. The education space is a really great industry for us. We seem to do a ton of work in the K through 12, along with the higher ed space. And so there you've got some representative examples, and it really has the ability to kind of move the needle. And it's a great tax planning tool for folks if they're looking to maximize deductions. So let's talk about how the deduction is transferred from the governmental entity to this quote unquote designer, right? What are the mechanisms around that over and above the energy modeling and energy efficiency requirements? And so there is something called an allocation letter. And the allocation letter is signed by the governmental entity and has, there you can see kind of a template of it, signed by the authorized representative of the governmental entity and signed by the designer. And it's very biographical information about the building, place in service, address, cost of property, et cetera, et cetera. And that information there that you see, those fields are required, along with the verbiage at the bottom, under the penalties of perjury. That information is all required, right? And so the first step, or one of the first steps in pursuing a 179D study on this governmental side, is for the designer to have conversations with the governmental agency to get this allocation letter assigned and signed off. So let's talk about what a designer is. And this kind of is a parallel or kind of the same thought process as Joe Stoddard mentioned earlier about the R&D development, right? Credit, right? When he thinks R&D, I think, beakers and lab coats. And when I think designer, I think architects and engineers, right? And those are certainly great candidates, and those folks are certainly eligible for this credit. You can see here some quotes from the code there. So the designer is the person that creates the technical specs for the installation of the energy efficient commercial building property, right? And so that can include an architect, engineer, as I mentioned, contractor, consultant, or energy services provider who creates these technical specifications. What we need to be careful there is that third paragraph, person that merely maintains, installs, repairs, and maintains the property is not a designer. So an example of someone that would not qualify for a designer, let's go back to the elementary school example. And let's say, for instance, the elementary school puts on a new roof, the roofing contractor comes and maybe puts in some insulation and the EPDM straight off of the plans and specs created by the architect. In that case, the roofing contractor would be inappropriate for that person to obtain the deduction. In that case, the person that created the technical specs, in this case, the architect, would be eligible for this deduction. So triggers on the 179D side, again, quote unquote, designers working with governmental entities. And there we can look at any projects placed in an open tax year, which is typically the last 3. And the majority of our projects are kind of multi-year engagements where we'll go back and maybe assess 18, 19, 20. And then now that we're have this permanency, we scope it out for 21 and moving forward. And then obviously the designer status. I'm sorry, the desire for deductions rather. So the key takeaways here, 179D up to $1.80 per square foot deduction. On the privately owned side, you can go all the way back to 2006. On the governmental side, you're limited to open tax year. 25,000 feet and more is typically where we start to see the interesting numbers happen. And certainly a portfolio project where we take smaller projects and aggregate them together certainly has the potential. All right, so let's switch gears here and talk about Section 45L. So Section 45L is a tax credit. It's not a tax deduction, it's a tax credit. And this tax credit is $2,000 per qualifying unit and applies to specifically residential buildings, 3 stories or less above grade. So think garden style apartments and townhomes. Single family homes certainly are also great candidates for production home builders. So really basically at the end of the day, any building that does not qualify for 45L typically would fall into the 179D bucket and vice versa. So across virtually all property types, you'll have one of these 2 opportunities, assuming you're able to meet the energy efficiency requirements and have the need for either the credits or the deduction. On the 45L, the requirements are kind of a variation on the theme that we saw on 179D. In this case, one needs to demonstrate a 50% energy savings below a certain standard, and that's the IECC 2006 standard, dissimilar to 179D, where we're based on the ASHRAE 90.1, but the same idea. You're going green, you're energy efficient, and you're eligible for this deduction, or this credit rather. One curveball on the 45L side is the building envelope, walls, roof, windows, things of that nature, needs to account for at least a 1/5 of the energy reduction consumption. So with that said, it makes the qualification on these 45Ls a little more challenging. The hurdle to get over is quite a bit higher, specifically on renovations, if you're not doing much in the way of envelope work, right? Not doing any new windows or walls or roof, it makes it tough, but certainly worth assessing if you have an opportunity. So some positive factors here. HVAC efficiency really does rule the day, along with the envelope. 2x6 construction, unless you're in a real temperate climate, really that is a minimum there for to take a look. Hydronic heating is a great fact pattern. Reflective coating, especially in the Southwest, for the solar heat is something we like to look for, and that's all part of our scoping process. If we have someone who's interested in taking a look at one of these studies will aggregate the plans and the specs and maybe some additional information about the projects, mechanical schedules, things of that nature to kind of suss it out and see if we have a viable candidate here. And if we do have a viable candidate, as I mentioned, the results can be substantial. So here you can see a 56-unit townhome complex. I believe this is in Colorado. There you can see the complex features in terms of the HVAC and envelope information there. And in this case, we were able to qualify 100% of the units, all 56 units were qualified and yielded $112,000 in credits for the owner. So it adds up. So some key takeaways here on the 45L. So it's as opposed to a per square foot as 179D, this is a $2,000 per credit, or $2,000 credit per qualifying unit. It needs to be residential, 3 stories or less. It needs to be sold or leased in an open tax year and prior to 2022. So just similar to the 179D that we saw made permanent earlier, this 45L is still one of these extenders. And as we sit here today, 45L is scheduled to expire at the end of this year. With that said, it's undergone 8 expirations and renewals since 2006. So we feel comfortable, or we feel confident moving forward that it'll come back, maybe not in its same shape, but certainly something similar will happen, especially given our new administration and makeup of Congress. We feel good about that. And then obviously, because it's on a per credit basis or per unit basis, the more units, the better. Typically 10 units is where we're starting to see some good traction there. And for anyone who's interested, is we create a provisional analysis similar to Joe Stoddard's kind of phase 1 assessment, where we kind of suss it all out. Is we'll go through and analyze the plans and specs and give you an idea as to the likelihood of qualification. And that's kind of just part of our cost of doing business, and are happy to do that for you. So I think we have about 5 minutes left here. So I will move it along to the next slide, and you can see Joe and mine and Mark's information there. If you have any questions, obviously feel free to reach out. Or if we have a little bit of time right now and we have any questions in the chat, I think we've got a couple minutes to address those as well.
Well, I will say this, and maybe this will answer some of the hands being raised. We threw a lot of stuff at you. Congress and the IRS have really responded to getting some cash flow ideas out there. And that was hard to do, but they've done it. And another hard part is actually implementing them. And certainly on the fixed asset services that you heard about, and energy incentives for our client base and beyond, we are taking a holistic approach in assessing all that's out there. So if you built a building, renovated a building, acquired a building, we're taking that, looking at some information and applying it to all the provisions possible and seeing which ones hit. And then we give back to you, hey, out of the 7 that have been out there, you're going to hit on 4 of them. And then we can talk about executing. And within our Eide Bailey community, we certainly do that on our dime, that assessment. And then you can make a decision whether you want to chase after these things.
Well, let's give everyone 2 minutes back in their day. So thank you all so much for attending. Thank you to our presenters. I hope that everyone